In this video, we will walk through a clear, structured overview of Danish VAT, so you can understand the essentials and manage your obligations confidently as a business operating in Denmark. Denmark applies a standard VAT rate of 25% on most goods and services, and unlike some other European countries, there are practically no reduced rates. From a business perspective, this means that once you are VAT registered, you generally charge 25% VAT on your taxable sales, collect it from your customers, and later remit it to the Danish tax agency, known as Skattestyrelsen, after offsetting eligible input VAT on your business expenses. The first key step is understanding when you must register for VAT. If you operate a business in Denmark and your taxable turnover exceeds the registration threshold, which is currently set at a relatively low level compared with many other markets, you are required to register. Even if you are below the threshold, voluntary registration can be beneficial if you have significant input VAT on purchases that you wish to recover. Registration is done digitally through the Danish Business Authority's online portal, typically at the time you establish your company or start your self-employed activity. Once registered, you will receive a CVR number, which is your business ID, and your VAT registration will be linked to it. From that point forward, every invoice you issue for taxable supplies in Denmark must show your CVR number, the date, a unique invoice number, a clear description of the goods or services, the net amount, the VAT amount, and the gross total. Danish VAT is calculated on the net invoice amount. For example, if you sell a consulting service for 10,000 Danish kroner, you add 25% VAT, or 2,500 kroner, and charge the customer a total of 12,500 kroner. You will later declare the 2,500 kroner as output VAT. The concept of input VAT is equally important. When your business purchases goods or services that are used for taxable business activities, the VAT you pay on these purchases can usually be deducted from the VAT you owe. For instance, if in the same period you incurred 1,000 kroner of recoverable VAT on office supplies, you would offset this against your 2,500 kroner of output VAT, and remit the net amount of 1,500 kroner to Skattestyrelsen. The key is that these costs must be linked to taxable business activities. Certain expenses, such as entertainment or mixed-use items, may be only partly deductible or not deductible at all, so it is important to understand and apply the Danish rules carefully or seek professional advice when in doubt. VAT reporting in Denmark is done electronically through the Tasteserv system provided by Skattestyrelsen. Your reporting frequency, monthly, quarterly, or semi-annually, depends on your turnover. Smaller businesses generally report less frequently, while larger businesses may be required to file monthly returns. In each reporting period, you summarize your total taxable sales, your output VAT, your input VAT, and calculate the net amount payable or refundable. Filing must be done by the statutory deadlines, and payments are typically made by bank transfer through approved channels. Timely compliance is critical, as late filings or payments can trigger surcharges, interest, and in more serious cases, audits or penalties. For businesses trading across borders within the European Union, the rules are more complex, but there are a few core principles to keep in mind. When you sell goods to VAT-registered businesses in other EU countries, these intra-community supplies may be zero-rated if specific conditions are met, including valid VAT numbers and evidence that the goods have been transported out of Denmark. Conversely, when you acquire goods from other EU member states, you may need to account for acquisition VAT in Denmark under the reverse charge mechanism, declaring VAT both as output and input on your return, often resulting in a net zero effect if the purchases are fully deductible. For services, the place of supply rules largely determine where VAT is due. Business-to-business services within the EU typically fall under the reverse charge in the customer's country, meaning you may invoice without Danish VAT but must include required wording, and your customer accounts for VAT locally. When selling to private consumers, especially digital services, separate EU rules and thresholds may apply, often managed through the one-stop shop schemes, which simplify reporting for cross-border B2C sales. Many businesses also have questions around VAT on exports outside the EU and on imports into Denmark. Exports of goods from Denmark to customers outside the EU are normally zero-rated, provided that the export is properly documented. Imports into Denmark from non-EU countries, on the other hand, are subject to import VAT and potentially customs duties, typically collected by the customs authorities. Depending on your setup, import VAT can be recoverable as input VAT in your regular return, but it requires correct customs declarations and bookkeeping entries. Speaking of bookkeeping, robust documentation is essential for managing Danish VAT. You should maintain organized records of all sales invoices, purchase invoices, credit notes, and relevant contracts, typically for at least 5 years, as required by Danish law. Your accounting system should clearly separate amounts with and without VAT and identify different VAT codes for domestic sales, EU transactions, exports, and special cases. This level of structure not only supports accurate returns but also reduces risk in the event of a tax audit. It is also worth noting that not all activities are subject to VAT. Some sectors, such as certain financial services, healthcare, education, and cultural activities, may benefit from exemptions under Danish and EU law. However, being exempt does not mean being better off. Exempt businesses generally cannot deduct input VAT on their purchases, which can increase their cost base. If your business operates in both taxable and exempt areas, you may need to apply partial exemption or pro rata calculations to determine how much input VAT you can reclaim. Finally, while the foundations of VAT are harmonized across the European Union, implementation details and administrative practices can differ by country. In Denmark, the system is highly digitalized, and authorities expect businesses to manage VAT proactively and transparently. To keep your compliance straightforward, build VAT considerations into your pricing, contracting, and invoicing processes from day one. Ensure your terms and conditions specify whether prices are inclusive or exclusive of Danish VAT, confirm whether your customers are businesses or private consumers and in which country they are established, and regularly verify EU VAT numbers when dealing with intra-community supplies. Consider periodic reviews of your VAT position, especially if your business model changes, you start selling internationally, or your turnover grows significantly. If you are unsure about specific scenarios, such as complex cross-border services, voucher schemes, or mixed-use activities, consulting with a VAT specialist can help you avoid costly mistakes and optimize your structure. In summary, Danish VAT revolves around a straightforward standard rate of 25%, but it demands discipline in registration, invoicing, documentation, and reporting. By understanding the basic concepts of output and input VAT, keeping accurate records, using the Danish digital platforms effectively, and seeking advice where necessary, you can turn VAT from a perceived administrative burden into a manageable, integrated part of running a professional business in Denmark.